Thomas Yao here at RDM Financial Group, Hightower Advisors. Let's go over where markets and the economy stand today. Markets have continued to grind higher, setting new record highs despite the ongoing government shutdown. Investors have been looking past the shutdown, focusing instead on resilient economic data and solid corporate earnings. The S&P 500, Dow, and NASDAQ have all reached highs, with equity and credit markets holding a constructive tone. Growth has been durable. The Atlanta Fed's GDP now is tracking around 3.8%, underscoring a resilient economy supported by steady job gains, rising wages, and easing mortgage rates. Although inflation is still a focus and the labor market is cooling yet still healthy, confidence is growing that the Federal Reserve will continue easing gradually. Corporate fundamentals remain strong. The majority of S&P 500 companies have beaten earnings expectations in the recent earnings season, supported by demand strength, disciplined cost management, and robust free cash flow. Margins are expanding, CapEx is rising, and companies are returning capital through buybacks and dividends. Elevated valuations are supported by durable earnings and strong balance sheets. On the policy front, the Fed's first rate cut last month, after a long pause, was positioned as risk management, not weakness. Inflation is around 3%, and additional cuts are expected to be gradual and data dependent. Globally, several central banks are also shifting toward easing, adding support to liquidity conditions. Internationally, growth remains uneven but improving. Global equities present selective opportunities in manufacturing, artificial intelligence infrastructure, and commodity stabilization. Sector leadership continues to center around technology, infrastructure, and industrials. AI remains a long cycle investment story, with corporate spending expected to grow at least high teens annually. Cybersecurity is another bright spot, while industrials benefit from reshoring and investment trends. In fixed income, yields have moved lower and credit quality remains strong. Investment-grade spreads have tightened and high yield remains well supported. Bonds have delivered solid returns as markets price in a steady easing cycle. Stepping back, markets are balancing resilient growth, earnings strength, and policy support against elevated valuations and a cooling labor market. Volatility may ebb and flow, but opportunities remain. Our focus stays consistent. Emphasize quality, actively review risk versus reward, and align portfolios with durable trends. We continue to see opportunities in artificial intelligence, energy infrastructure, and sectors positioned to benefit from lower rates and disciplined capital investment. Overall, risks remain, but the backdrop is constructive. Markets are looking past short-term noise and focusing on an economy that remains generally strong, fueling mindful and cautious optimism as we head into year-end. Thank you for listening, and I look forward to speaking with you again soon.